Hi there, Dr. Adam Gower here, and welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com. And welcome also to a world I have avoided until today, the world of crypto, blockchain, tokenization, and everything that comes with that. So if you're anything like me, don't hang up now just on hearing those words, but listen in, and here's why. Blockchain, tokenization, etc., and we'll get into the definitions in this podcast, will do nothing more to what you're doing today than emailing contracts did to replace FedExing hard copies to someone overnight. We got over that hurdle, right? No more hard copies needed. Electronic signatures are just fine. Well, blockchain technology is just the next evolution, and in my opinion, the only reason it's so badly received so far is because advocates, forgive me if you're not one, are techies, not marketers, who have no clue how to sell it. Right? Seriously, stop saying blockchain and instead just say, hey, there's an app for raising money for your deals that you and your investors can put on your phone so you never need to email anything or use DocuSign ever again. You'd buy that, right? It's the language that's the killer, not the tech. Now, you don't have to take my word for it, as you're going to hear in today's episode, but first, thank you to Michael Flight at Concordia Realty for opening my eyes to this field. He did it by introducing me to a paper called Tokenization, the Future of Real Estate Investment, produced by none other than the University of Oxford in England, one of the top, most credible academic institutions in the world. Now, I had not seen anything so credible on the topic of tokenization than this paper that Michael sent me, so I called the author of the report, Professor Andrew Baum, to see if he'd walk me through his research, and it is exactly he who, I am honored to say, is my guest today, and from who you can hear directly about the confluence of commercial real estate and tokenization and why it is something you should be paying attention to. What you're going to learn will open your eyes to a new way of doing exactly what you do already, like the email versus hard copy letter analogy I used earlier. But it's not a panacea for selling your deals online to investors. It's not a silver bullet for that. You still have to get out there with a sophisticated digital marketing system. And the best way to figure out how to do that is to go to the podcast page for today's episode and sign up for the free training I put together in the whiteboard workshop, where I walk you through everything you need to do to raise money online. You'll also be able to download Professor Baum's paper on tokenization on that same page. Again, that's at the podcast page for today's episode at gowercrowd.com. Now, before I turn you over to Professor Baum, be sure to stick around to the end of the podcast where he gives some of the sagest advice you're going to hear anywhere about how to tap into this new technology of tokenization so that you can learn more about it and be there when it eventually turns somebody into a billionaire, maybe even you, with zero risk and nothing to lose. All right? So stick around right at the end of the podcast for Professor Baum's advice. Okay, so here we go. My great pleasure to bring you one of the world's most credible experts on the subject of tokenization and what all that means for commercial real estate, Professor Andrew Baum from the Saïd Business School at Oxford University. Professor Baum, thank you so very much for joining me today. I know we have a large difference in time, so it's pitch black here and bright daylight your time. We're going to talk about actually something in which I sit in pitch blackness, and that is the world of crypto. What on earth is it? And I know that you live in a world of complete lightness, right? You understand it very well. So I would love to know, the first thing I'd like to know, if you don't mind, is please tell me, what is crypto? I've read your paper. I'm going to include it on the show notes page for today's episode, but there are so many different terms in there. Why don't we start with that? Cryptocurrency, tokenization, digitalization, fractionalization. Can we start with just a definition of what we're talking about when we talk about crypto?
That's fine. I mean, I have to give you a sort of a health warning first. I mean, the things I understand in descending order are fractionalization first, tokenization second, blockchain third, and crypto last. So I might disappoint you a little. So if we go for the most extreme, radical, crazy possible thing, you would talk about a cryptocurrency-backed tokenization scheme underpinned by blockchain, right? Now, as soon as, if we're in crypto, if we're denominating a fund or an asset in cryptocurrency, we're already in the world of blockchain, because blockchain is the system that allows the register of ownership of these currency tokens to be registered or to be transacted as well. So blockchain is the underpinning technology underneath Bitcoin originally, and then more popularly Ether. So Ether is becoming much more broadly adopted as the sort of global blockchain system, and Ether is a sort of a currency which is slightly more universal, I think, for the purposes that we're talking about. So we're talking about a unit of exchange which is traded digitally, seamlessly by people through apps, that sits somewhat outside the global financial system and the banking system. And any currency can work as long as the people on both sides of the transaction agree that it's what it is. So I could agree to buy your car for 3 Baums, and as long as you accept what a Baum is and I accept what a Baum is, and it doesn't have to have any physical value. It could be a plastic disc, but as long as that plastic disc is not easily replicated by other people, then it's got value. And the point about cryptocurrencies, it can't be replicated. It's issued in finite quantities. And as long as you've got some digital system which is saying there are only so many million tokens, then they will retain a value. What that value is, of course, it's not underpinned by any fundamental value, and that leads on to an interesting question, Adam.
That leads on to an interesting. Okay, now good. So let me just try and paraphrase that, because I really am sitting in the dark here, quite literally and figuratively. So let me just try and paraphrase that, and then we'll move on to the impact on real estate. What I think, fractionalization is something that we've seen already. Fractionalization is selling shares, right? We're basically selling it to more than one person. But a cryptocurrency is a technology, right? It's a technological solution to that fractionalization. Is that correct?
It's one possible solution to fractionalization, yeah. So as I said, I think I'd rather go, if we go down the order of simplicity, we start with fractionalization, go to tokenization, then go to blockchain, and then go to crypto. That would be more logical.
Okay, so so how do you want to move then? Because my next question was, how is this world of, again, blockchain, and this is where I'm not really sure where these terms interact, right? Is blockchain the same as crypto, essentially, or is it, what are these,
so blockchain is a useful technology without cryptocurrency. So it's a useful way of recording ownership of whatever. So I was talking to one of our sponsors recently, and they came up with an example where farmers in Australia are sharing the use of a tractor. It doesn't make any sense for any of them to buy a tractor because they're only using it for 1/10 of the time. So they buy it as a cooperative. They register the ownership and the usage of the tractor on a computer system. And the computer system is automatic, so that when you sit on the tractor and you put your card in to make it work, the card is registered to you and it automatically logs up use that you're making of the tractor. And that records a debt that you have to the consortium. So as a result of you sitting on your tractor for a half an hour, you are going to be accumulating a liability to the other 9 farmers, and they're accumulating an asset. And that is being recorded through time, in real time, and it will be recorded in a distributed ledger. Now that distributed ledger is 10 accounts, 10 passwords, 10 computers, all of which are sharing this data. That that Adam sat on the tractor for half an hour and he owes all the other 15 Aussie dollars. Okay, and the blockchain system records that seamlessly. There's no central authority controlling this. There's no Facebook, there's no Google, there's no Amazon. These 10 farmers are sharing this system. They've all got access to the system through a password. And as long as they all say, yeah, that's reasonable, and tick it off, then they're all going to be in agreement that this is a cooperative that's working without anybody in the middle refereeing. So blockchain is just the distributed ledger system that records the activity and automatically bills them. So at the end of the month, you know, Jim is up 3 and Adam's down 6 and so on.
Okay, so that's very interesting. Oh, that's very clear understanding. Helps me a lot. But so now, how does this apply to real estate? Now, you've talked about this a lot in your paper. By
the way, Adam, I think you understand a lot more than you're letting on here, but I'm going to sort of I'm going to go with it anyway. So so where real estate comes in handy is when I started off talking about units of exchange having no intrinsic value. You got that is a problem and an asset. You know, you can say it's an asset because it makes it easy and frictionless, but it's a problem because there's no underpinning of the value of Bitcoin. So Bitcoin becomes incredibly volatile. So people buy Bitcoin, they can make a huge amount of money, they can lose a huge amount of money because the Bitcoin is not underpinned by any intrinsic value at all. So the value of Bitcoin is completely in the heads of all the people who are interested in trading Bitcoin. And if somebody puts the message out that Bitcoin has fallen in value and will fall in value, people start selling it. The word goes around and suddenly the price crashes. And there's no floor. There's absolutely no floor because it has no intrinsic value. So here's a neat idea. Why not attach one Bitcoin to one piece of real estate? Let's say a square foot. And one of the earliest ideas I heard was from a Ukrainian gentleman who said, we're gonna sell a square meter of Ukrainian real estate for 1 Bitcoin. So every Bitcoin buys you 1 square meter of Ukrainian real estate. That's not very clever because, you know, 1 meter of Ukrainian real estate isn't worth the same as another square meter of Ukrainian real estate. So really, you end up in a situation where you would like to underpin the value of the Bitcoin with something physical, with an intrinsic value. Property is fantastic for that because property is not volatile. It's the absolute opposite. And if you're a Bitcoin speculator and let's say you've got $500 million worth of Bitcoin, wouldn't it be great to take the volatility out of that by attaching it to a £500 million property portfolio? And then the value of your Bitcoin can only go up or down if the property portfolio goes up or down in value. Now, you wouldn't do that with Bitcoin because Bitcoin's already got its own market. So you'd have to create another cryptocurrency. Let's call it Propcoin. And you say that $1 US worth of this real estate portfolio is trading for 1 Propcoin. So you have a property fund with $500 million worth of real estate in it, and there are 500 million Propcoin tokens in circulation. Okay, and each Propcoin token is worth $1 to begin with, and it can't rise in value much above the value of the real estate portfolio, and it can't fall in value much below the value of the real estate portfolio. It could move to a premium to NAV. It could move to a slight premium to the value of the real estate if for some reason people think that there's a value in the liquidity of the token.
Yeah, maybe they suspect that a big tenant is going to move in that hasn't already moved in, right? So they would hedge that by paying more for the
That's
share.
Really interesting, Adam. I think we've now got 2 reasons why the prop coin might move to a premium. One is because there's insider knowledge about the property itself. So the valuation becomes stale in academic parlance. So the stale valuation, there's new information, which means that the property is worth more than it has been valued at. Mm-hmm. So there's a real-time market value of the real estate, which is reflected in the prop coin value. So the prop coin starts to disengage a little bit from the valuation of the asset because there's more information around, and the valuation ultimately catches up with the trading price. But there's another issue, and that is whether the prop coins themselves have a value above and beyond the real estate because they're liquid and tradable and outside the financial system and non-regulated. So you might say, I'm going to pay you $1.10 for a prop coin unit, even though it's backed by $1 of real estate, because there's 10 cents worth of liquidity, fashionability, you know, whatever it is. that has pushed Bitcoin to very high levels. You see, and at some point people might say prop coin's the thing to be in. Have you seen prop coin? So.
Yes, so this is something that you talk about actually, is this question in the paper, is this question of liquidity versus illiquidity.
Right.
And the key to understanding how cryptocurrency or how blockchain or fractionalization in this sense works with real estate is that real estate always requires a manager. There always has to be an intermediary. So you're never really buying a piece of the real estate. You're buying a piece of an intermediate company that is being operated by a sponsor, and your profits and loss associated with the value of whatever it is you hold, whether it's $1 or it's 10 units of shares or it's 10 prop coins, is going to be determined by that manager, and you're going to pay that manager. So the way that I've internalized this, based on reading your paper, and I have to confess, it's really the only thing I've ever read. I've been completely resistant to this because it seems like it's beyond anything I could understand, but you're making it quite clear, is that it just provides a different currency for sponsors to be able to finance their properties. And that because it is in this world of kind of non-regulated world, that it allows investors to trade it. So that seems to be the primary advantage. Is that a fair? Again, I'm kind of based in the States, so that's the world I see.
No, it's the poor backward States that doesn't understand finance. I know. So what you say is absolutely right, and of course the whole concept is bananas. So let's cut to the chase. The whole idea is bananas. Unfortunately, it's elegant, it's beautiful, it's appealing, but the reason why it's bananas is because you have to go through all these traditional processes when you're creating an investment product. And so you can inhabit the nether world outside any national regulation or financial system, but that is going to be that's a dark world. That is the world of selling assets from Ukraine to Azerbaijan outside the financial system. If you want to do this in the US or the UK, you're going to be creating so if you want to fractionalize a piece of real estate, you want to split it into pieces. It's going to be a company, it's going to be something. You can't split a piece of real estate into 1,000 pieces. The law doesn't allow you to do that. Physically, it might be possible to split it in half. You might be able to split it by floor, but you can't split it into 1,000 pieces. The concept just does not work. You can create a company out of the piece of real estate and split that into 1,000 pieces. And once you do that, you are creating a tradable security, and it will be called a security, and if you want to call it a token, and we'll come on to that in a minute, it'll be a security token, treated just like any other security. So it will be regulated by the SEC or the Financial Conduct Authority in the UK. And immediately you're back in the system. The whole point of being in crypto or tokenization is that you're outside the system to some extent. Well, you're back in the system now because you've had to create a company. The company is going to be regulated, probably. The manager of the company is going to be regulated. The token itself is going to be a security token and therefore regulated. And all the costs that go along with that and all the lumpiness that goes along with that means that you've failed to create this sort of beautiful new world that you want to create. And further, as you quite rightly pointed out, somebody has to be in control of this. If you've got a building which is split into 1,000 pieces, you cannot possibly have a system where you need 1,000 signatures to agree that you're going to replace a window. So somebody has to be elected to be in charge of this. And how does that work? Well, it works in traditional law. We know how that works. It's a company that appoints a board of directors to represent the shareholders, or it's a unit trust where there's a trustee acting on behalf of beneficiaries, or it's a limited partnership where you've got a general partner and a set of limited partners, or it's an LLC or whatever. So you're just back into the traditional world. And why would you try and recreate a whole new body of law when it already exists and everybody knows how it works? You're going to keep ending back where you started in the traditional system.
Yeah. So this is what begs the question, right? So the way that I've understood it is that it really is, it's just blockchain and crypto, and I understand for fractionalization and such. Basically, it's just another form of security
Yeah.
But one of the things in the paper that you quoted was somebody who talked about it making, and I forget who it was exactly, that's from page 27. Anybody wants to read it actually later. Bottom of page 27, somebody talks about creating a much more efficient system for trading real estate. So let's assume that we still have our owners, our operators who set up a company and they sell, let's say by blockchain, or to create a currency of some sort that they distribute, and et cetera, et cetera. That's all fine and well. But the idea was that somehow using blockchain makes information sharing much more efficient. For example, title insurance, right? And the history of so this begs the question, this is the question that I have, and the people in my network, certainly when I talk about this subject, they roll their eyes. The question is, well, how does that work, right? How does that work? We know what it takes to do historical research, basically title insurance. I'm a historian. Title insurance is nothing more than examining history. How do you apply a technology to make that process any easier? So what is it that we're talking about?
Okay. There is a beautiful world down the road. It might be 25 years away, by which time there's another technology which makes it obsolete. But there is a beautiful world out there which says that all data to do with a piece of real estate becomes digital. And we're in a world where it certainly isn't at the moment. But if you can imagine a brand new building with the architect's drawings being digital, all of the appliance manuals being digital, and ultimately intelligent, so that they're not just dead documents, they're actually live documents. So every time something's done, the document changes. You can imagine that all of the wiring in the building is discoverable through some sort of digital file rather than hidden behind a wall that you can never find. Every photograph ever taken of the building is loaded. All transaction history is loaded. All ownership records are loaded. Everything you possibly want to know about the building is in a digital file, and that digital file could be transferred with the ownership of the building when somebody buys it. That would speed up transactions, and it would also allow buildings to be split into small parts, because all of those files could be just split easily. So you say you're buying 1,000th of the building, well, you've got an entitlement to 1,000th of all this digital information. You share the digital information like everybody else. Everybody's got it, and you own a bit of it. The problem is that if you're buying a piece of real estate, whether it's the whole thing or 1,000th of it, you're going to do a lot of due diligence. You're not going to sort of just walk in and say, okay, I've got the digital file, that's all I need, thank you very much. You're going to employ a lawyer or a real estate consultant or a tax advisor to crawl all over this thing. And the only prospect we've really got of getting to the beautiful new world is where we have completely digital data, but we also have a completely reliable insurance system that says, okay, you can buy the building instantaneously and you get the benefit of the digital file. You've seen the building, you've got the digital file, it's all there, it's all transparent, and you are insured. So if there's anything wrong in that digital file, you're covered. Then I can see me going online, looking at a building, saying, I fancy living there, bang, I'll buy it. Instantaneous transaction, smart contract, blockchain enabled, and a blockchain system that connects all the people who are interested in buying these buildings. And if they're split, if you take an apartment block with 100 units, then there's one file split into 100 pieces and 100 different files for the individual units. And we all share the information about the building, the architect, the construction process, the plans, everything. And that's held in this beautiful, efficient blockchain system, and we're covered by insurance. So if there's any defect in that information, we can sue somebody or the insurance company pays out. Then you get to faster transactions. And it has to be said that blockchain aficionados and digitalization aficionados have got a point. It's crazy that we have to keep producing pieces of paper that have to be rewritten. The information is there, sitting on a piece of paper. People are retyping that information from a piece of paper into another piece of paper. That goes into some sort of system that can't be read by the lawyer. The lawyer's system is different from the property advisor's system. So that we are, making a huge amount of errors and lots of mistakes and huge inefficiencies because of the old system. But getting to the new system will take quite a long time. That's the problem. It is beautiful. It's elegant. The first step is digitalizing the data.
That's really a fascinating vision that you've just painted. Again, the question. So let me ask this: is anybody in what way is, because I could just keep on drilling down on these questions. It's absolutely fascinating. But is there any way that real estate is that this technology is already being used in real estate? And you described a kind of a future for how it might work. And it totally makes sense. Every time a building is transacted, somebody goes and does the exact same work as the last person did. And whoever's selling it hopes they don't uncover the little bit, right, that they've discovered in the interim.
Yeah, absolutely. I mean, I think there are a few sort of semi-successful efforts to use blockchain to trade buildings, but they've had to work in parallel with the traditional system of transacting a building. So there's been no examples of a pure blockchain trade of a building that I'm familiar with that wasn't in parallel with a traditional title transfer process. So a lot of people can say, well, I've used blockchain to, so you create a file, you create a system, you create the information, but you still have to do all the things that everybody else has had to do to transact the building to make it work. All you've got on top is just a digital file of information, basically, in parallel with everything else you've got in paper and that your lawyers have gotten. The most likely and the most likely successful and currently occurring example of blockchain-enabled real estate transactions is property funds. And we say this in the report quite strongly, this is a strong conclusion, that jumping from a single building to a fractionalized interest, to a token representing that fraction, to blockchain being used to underpin that, to even using a cryptocurrency to measure your interest in that, requires several huge leaps of faith.
Yeah, that's again the word I was thinking was trust. Yeah,
right. It does, absolutely, and it requires an overt it requires an obvious and proven demand for shares in buildings as well, right? Which may or may not exist. And I know you're interested in crowdfunding, so but open question whether there really is a deep demand for splitting big buildings into small pieces for people to buy. That's an open question, I would say at best. On the other hand, if you go to the world of funds, you go to the world of funds that are diversified pools of real estate, they're already in the right shape for this. They're already fractionalized. Mm-hmm. That's the whole point of a fund, is that it's unitized. It's a collective investment vehicle. So it's already split into units. So you don't have to sell the idea that there's no demand for this, because we know there is. That's what it is. There's already the intermediate legal structure in place. It's already going to be a company, a fund, an LSE, an LLC or a partnership. It's already going to be in the right legal form. It's therefore going to be managed by a regulated entity. Therefore, it's in the system. The only leap of faith then is, where's the liquidity in trading these damn things? If I buy a share in the UBS Trumbull fund in the US, which is $7 billion worth of assets or something, how do I trade my position in that? Once I've bought, $500 million worth of this stuff, how do I trade it? And that world is a dark world. It's a world of dark pools, or going through the manager, or redemptions, or queues, or all sorts of things that make this clunky. So I want to sell my units in that fund. I might have to join a queue, and it might take 2 years before somebody says they can buy my units. So why wouldn't we just have a secondary market, right, which is traded seamlessly, digitally through an app, and you may as well put that on a blockchain, because that's the way of distributing the information. So all of the 1,000 unit holders in the UBS Trumbull fund now have access to a system that they all share, which has got all the data about the fund in it, and the trade could be done instantaneously through an app supported by this digital ledger.
What restricts that now? Isn't it legislation that restricts secondary trading, or is it the sponsor that decides they don't want people to trade the shares in the companies that they form?
There's nothing getting in the way of this, other than the need to really understand things like custody. And the whole process of trading shares is another world that I don't understand particularly well, but stockbrokers, market makers do understand. And it's getting to grips with that system. There are people who are now using that knowledge to set up platforms for trading these funds. And, you know, they have knowledge of a different segment to the market that I do.
You know, so this gets back to the question of liquidity. Thinking at it from a sponsor's perspective, one of the reasons that you would not want shares to be traded in a hyper-liquid world, when you know on a day-to-day basis that what you're working with is illiquid, is that if you're in the process of trying to raise capital for future deals, and suddenly there's, for some reason, unrelated to the reality of what you're actually doing on a day-to-day basis, the shares, right, however they're defined, the cryptocurrency that you've formed suddenly plummets in value, or the shares plummet in value, it would make it potentially impossible to raise more money for the next deal, right?
Yeah.
Kind of create this false lens of what's going on.
Yeah, yeah. I mean, that's the world. You know, that's the world of REITs, isn't it? That's the world of the listed company. It's the world they have to deal with, and it becomes impossible to raise capital when you've got those discounts. So yes, and I suppose what people, including me, would hope for is that to some extent you can get the best of both worlds. Now, you know, I don't believe you can, but you get something. So to me, the world of real estate involves this trade-off between liquidity and volatility. What we really want is liquid assets that aren't volatile. We want our property valuation to be dominant in the pricing of something, but we want to be able to trade it. And that's a false hope, because if you make it really liquid, it will be volatile, as you suggested. It's sure as eggs is eggs. So I suppose what we're trying to, what my utopian ideal looks like is a measure of liquidity in these property funds that enables people to trade with some efficiency without creating such enormous liquidity, which you know, that would create enormous amount of volatility. And I do think it's a reasonable hope, because, you know, why would a piece of real estate move rapidly up and down in value if it's disconnected from the stock exchange? You know, what information are you going to use to shove your prices up and down?
Yeah, but you know, this is where it becomes, this is where there's such a, the biggest issue is one of trust. So in the world that I inhabit, when you talk, for the most part, when you talk about blockchain, there is a lot of eye rolling, right? Yeah. Like, what is this? Is some kind of wacky idea? If people in blockchain who are trying to promote it, instead of talking about blockchain, and I'm pulling this out of my ear, but it's my perspective of it, they stop talking about blockchain as being the solution, but instead just describe the solution and the benefit, right? Yeah. Without saying this is the technology behind it, because it's the technology that people don't trust. And yet, every day, we trust everything that happens on here and how it happens. Yeah. We don't give it a second thought that this is going to work. When I send money, right, using this, I totally trust that it's working, right? Yeah. So removing even the concept and the words, the terminology, the language out of the equation might make it more efficient. Right?
I think you'll find that that's what people are trying to engineer now. So the word blockchain has become much less popular. Distributed ledger technology has become more popular. That term might just disappear at some point. It just becomes a nothing. You know, it's just the technology that underpins.
Exactly. Right. Exactly. If you said we're going to send your money by HTTP and CSS and something, I was like, what the heck's that? No, I don't want to. I don't want to do that.
No, you're right. At some point, we won't care what the technology is. We'll just want to know that we can trade our units on our app, and that'll be it. And you know, we'll get somewhere when Hines or Tishman Speyer says, right, okay, you can now trade units in our funds through an app, subject to. So all of the investors in a Hines fund will probably be, they'll have gone through KYC and money laundering checks, so they're qualified. So it'll only be open to qualified investors who are already investors in the fund. But the first step is Hines says, right, okay, we've now got a digital platform. You can now go onto this digital platform and you can say, I am looking to sell 500 units in the Hines fund, right, and just ask for people to come forward. and either match the bargain or go through some sort of intermediate clearinghouse. If that will happen sooner or later. It's already happened in small funds that aren't managed by big names. That's happened in Germany with a £200 million fund, and so on. So it will happen, and Heinz will get to the point saying, well, this is an efficiency. It's going to enable us to cut our fees and it will enable us to take in smaller investors as well, because, you know, once you've got an online system that pre-qualifies investors into our pool, we don't have to go through massive amounts of paperwork. We can take $500,000 from somebody instead of, say, a minimum $10 million, because it's a digital system. And then Heinz and Tishman Speyer will get together and say, okay, well, we're going to share the cost of developing a platform so that people can actually trade units in the Heinz fund for units in the Tishman Speyer fund. And then the thing starts to grow out from there. And then eventually, the Empire State Building is a fund which is traded on the same system. And then maybe a smaller building gets traded on the same system. And then maybe you get to all this tokenized, digitalized world of individual assets. So crowdfunding online in that system. But I think it's got to come from the big guys to make it credible.
That's interesting. Yes. And actually you do actually start using the term crowdfunding. But before we get to that, what are smart contracts? How do they work in the real estate world?
Well, they don't, but they don't work. But the idea is that the contract is a digital instrument which is tied to other digital instruments which populate the piece of information, and the contract can become binding through some automated action, so that once all the documents are in place and all the pieces of information are in place, somebody approves that all those things are in place, the digital contract is then automatically executed and goes into your bank account and sucks money out of your bank account, so there's consideration on the other side.
Okay, so again, this is like trying to describe how a payment to Amazon on your phone works.
Operates just like a smart contract, yeah.
It's the same thing. I'm just trying to kind of cut through the fog. Basically, we're talking about technology that we don't need to really know about, do we?
It's a laudable aim, Adam, but the fact is there are loads of people like me. The only people making money out of this stuff are people who stand up at conferences like me and charge a fee. And we're all tempted to pretend we understand what's going on because we're being paid a fee, right? The fact is, I don't really understand the answer I just gave you, really, about smart contracts. You know, I've been told what a smart contract is several times. I've read it, but I've never done one. So please don't rely on what I just said as you know. I'm only guessing.
Look, we live in a world. We live in a world where the truth is whatever you can say with confidence, right?
That's great, and it's great being a professor, Adam, because people seem to write down everything you say. And the phrase we use is, "In the land of the blind, the one-eyed man is king." You know, and I've got half an eye, I think.
Right, which is more than anyone else. That's why I was saying it's perfect. I'm sitting in the dark here, and you're in a bright room, so it's actually a perfect sound.
Semi-bright, yeah, semi-bright.
So one thing that you've mentioned a couple of times now is crowdfunding. By the way, how are you doing for time? We good for time?
About 5 minutes.
5 minutes.
All
right. In that case, let's. I'm going to go straight to the bottom of my list of questions. I won't even talk about crowdfunding, because crowdfunding is nothing more than, as I see it, it's nothing more than marketing. That's all it is. It's just a way of,
It's just a capital raising.
In the United States, crowdfunding is nothing more than a relaxation of legislation that allows you to advertise. That's all it is. You used to only be allowed by legislation to talk to people you knew. When the law changed and crowdfunding became legal, now you can tell everyone, which means you can now advertise, which means you can use the internet.
Right.
So it has no direct relationship to blockchain or fractionalization or crypto, whatever you want. It's nothing to do with it. The operators still have to decide what instrument are they going to use. Are they going to accept cash in bags coming in, right? They're going to take a wired transfer. They're going to take a blockchain or a cryptocurrency of some sort. So let me ask this, just as we wrap up then. Where do you see, you've already articulated a little bit, but where do you see the near future? What are the biggest hurdles to seeing blockchain and cryptocurrencies and fractionalization in this sense from really becoming mainstream, even with companies like Heinz? What are the hurdles? And where do you think this breakthrough, or when do you think this breakthrough is going to start happening? I'm asking you to make a prediction, but...
Okay, so I predict that within 5 years, the bigger real estate fund managers will have invested in and launched a digital platform for trading units and raising capital in their funds. And once that has happened, we will then start to see more developments in the digital underpinning of property transactions and maybe single property asset transactions. But it will start with the big guys and the retail property funds. And the reason is because in a world of low interest rates and low returns, the fee levels that these guys are having to charge is too high. The cost of capital raising is just immense. So if I give you a quick anecdote, there was a guy called Keith Breslauer in London, a New Yorker. Runs a company called Patron Capital. Patron Capital raised its fourth fund, $900 million to invest in European real estate. He'd already raised 3 funds successfully. You'd think it'd be pretty easy to raise his 4th fund. And it was to some extent. You know, he's a well-respected guy and a well-respected brand, but he had 497 meetings to raise that capital.
Yeah, I was going to ask you who that was. You mentioned him in the thing. Yeah, that's exactly right.
How can that be a sustainable business?
That's how it's been done, Andrew. That's how it's been done for the last 100 ever. Right.
These guys are getting mid-career burnout and selling their businesses because they can't possibly cope with it anymore.
Exactly. Yes.
So it's just not sustainable. So we have to have an online system for capital raising at some point. You'll still need to look at the guy face to face. You'll still have that one meeting or two maybe, but you're not going to have 7 meetings with these people. It's just not working. So that's my hope, that the primary capital raise will become somewhat more digital. With the documents in data rooms, that's got to be an efficient way of doing it. People should be capable of building systems which crawl over that system and pick out the ones that are of interest to them and then engage with the managers. And then there's no reason at all why we can't have a modicum of secondary market liquidity engineered through some sort of digital platform in these funds. And as I said before, the reason the funds is the place to start is because they're already in the right legal form, they're already fractionalized, you know, they're already regulated. So that's the place to start, get that working, and then we can then push out from there.
Fantastic. Can I ask you 3 sign-off questions? These are questions I ask all of my guests, just one-liners at the end. But just right before I do, thank you for finishing with the 497 meeting example, because that is actually exactly what I do with crowdfunding. And it's actually it's clearly then the interface between, or the connection between crowdfunding and blockchain, is that it eliminates that need. Crowdfunding is allows for nothing more than being able to record your meeting, to record your intelligence and your thought leadership, and let people consume that so that when you do meet them, they already know you. That's basically all it is. 3 last questions. And this again, I ask all my guests at the end of podcasts, what are the key daily habits that you have personally that make you successful in what you do?
Is that 3 questions?
That's 1. But you can answer 3 things if there are 3 things. That's 1, and then I've got 2 more quick sign-off questions.
Get up early. I get up early, same as you, right?
That's a good one,
it. Right? So that by 9 o'clock I've killed a hell of a lot of emails and I can have a day, and then come back. Get up early and go to bed late. I mean, I've got no way out of that one, really. Work hard. I mean, that's it, isn't it? And we're lucky if we're born with energy, we're lucky.
Second question. So normally I ask people, what's the hardest lesson you've learned in real estate? But as an academic, what is the hardest lesson you've learned in your career?
I've learned lessons in real estate. The hardest lesson I've learned is that development is an incredibly risky venture. And I've been in situations where people have pretended that they understand the risks of going into a property development, and they didn't, and we lost a lot of money. And I think people tend to pretend that they know things. The comment that I made earlier that I can pretend I know this stuff, but actually I don't. I think we need a lot more people saying that a lot more times, because property development is a really risky thing to do.
Final question. Advice for somebody who's listening now, a developer or a sponsor who's curious about using blockchain in some way. What advice would you give them as they start looking into this technology and this way of fractionalizing their data?
Become friendly with a startup that are desperately keen to get friends who are on the inside, who understand the industry. Don't invest in them. Don't give them money. Don't give them any commitments until you completely understand what they're doing and completely trust them. But mentor them, and let them mentor you in what they're interested in, so that we start to, bridge this gap between the tech startup and the old guy like me.
That's brilliant advice. Thank you, Professor Baum. I really appreciate your time today. Thank you so much for being on my podcast.
Pleasure. Good luck and thank you. Cheers.
Okay, do you believe me now? Blockchain will just make your life easier doing what you're doing anyway. And if I would stop talking in terms of the technology and instead focused on the benefits and stop calling it blockchain that has all these negative connotations, it'd be a lot easier to buy into. That what email is to hard copy contract analogy again. And hooking up with a startup is an amazing idea. Do as Professor Baum suggests, give them insights, don't invest, but learn from them and take a piece of their action in return for your advice. And who knows, they could end up being the unicorn everyone's expecting. And either way, you will be ahead of everyone else who is still out there, like I was yesterday, electing to pay no attention to this new technology. Remember, to find out also how to build your own world-class digital marketing system so you can raise money online completely unconnected to blockchain, watch the whiteboard workshop on the podcast page for this episode at gowercrowd.com, where I walk you through the whole system. All right, that's it. Thanks for listening. And thank you, Professor Andrew Baum of Oxford University, for your time with me today. It was absolutely fascinating. I am on the hunt now for a small blockchain company to mentor about commercial real estate. Really good suggestion. Thank you. That's all for this episode. I'll see you next time. And for now, this is Dr. Adam Gower signing off.